Silicon Valley has collapsed, making it the second biggest banking collapse in history. But is this simply a one-off event or the beginning of a daisy chain of more bank collapses to come? And what does a 6% year-over-year CPI mean for the market as well? Is the Fed about to pivot with all of this chaos happening around it? In this video, we're going to look at just that. Before we get started though, nothing in this video is financial advice. I am not a financial advisor. Do your own due diligence. It's your money, your responsibility. With that said, let's go ahead and dive in to our first graph here. This is a pretty cool chart that I found, basically a bubble chart. We have all of the different banking collapses in history. And as we can see here in blue, Silicon Valley Bank at $209 billion, dwarfed only by Washington Mutual at $307 billion. Now, this is not something that's unprecedented. As we can see here, there's been plenty of other banking collapses in history. But nonetheless, this has been the second biggest one. So it is something to note. But is this indicative of a further contagion to be had? I want to take you to an article here by Fed Guy. If you don't follow him on Twitter, I highly suggest that you do. His name is Joseph Wang, Fed Insider. You may have seen him on a bunch of other YouTube channels as well. But we're going to go through his article here, which I have in the description below, called Hidden to Market. And basically, the gist of it is, guys, there's little risk of a crisis in the banking sector. But that doesn't mean there aren't badly run banks. So QE and Basel III have made banking sector significantly more liquid and resilient, such that a replay of the great financial crisis is very unlikely. But nonetheless, individual banks under poor management can still be subject to bank runs. At a high level, a bank has short-dated liabilities and longer-dated assets. So a well-managed bank holds enough assets to meet potential outflows. So essentially, when people come in to withdraw their deposits, there's actual money there for them to withdraw. That wasn't the case with Silicon Valley Bank. Silicon Valley Bank, essentially what they did was they placed a bet on artificially low interest rates. They were betting that the Fed was never going to raise interest rates, at least not in the near to medium term. And they took their depositors' money and converted it to treasuries. And so when interest rates started going up, the value of those bonds, those treasuries, went down. So they had accrued a bunch of unrealized losses in the process. And then finally, when whales came in, when people came in to withdraw their money, significant depositors, the money just simply wasn't there. And that's essentially the gist of the Silicon Valley Bank collapse. I'm sure there's like different intricacies around it, but from a 60,000 foot view, that's essentially what happened. So a good bank manages their liabilities to avoid substantial outflows. So this post reviews the basic liquidity problems banks face and shows how SVP was particularly poorly run, and suggests that higher rates in QT will challenge bank liquidity in the coming years. So here we've got banking sector, high quality liquid assets in the trillions of dollars. You can see here we've been going through a little bit of a downturn in liquid assets in the banking sector, going from just about 9 trillion to what is this, like 7? So a $2 trillion haircut. We're seeing this across the board, but the issue at hand was primarily contained with SVB. Another cool looking chart here, unrealized losses on securities. SVB had by far and large the highest percentage in relation to its total assets at 8%. Nothing else really comes close aside from maybe Huntington and KeyBank, but even those are just like under 4%. A little under half of what SVB was doing. So banks don't have to mark all their assets to market, but unrealized losses have a direct impact on their available liquidity. All assets on a market balance sheet fluctuate in value over time, depending on factors like interest rates and market conditions. So, and what changed this year or the last year or so? Interest rates. Interest rates went from 0% to 4.5. Suppose a bank bought $100 in treasuries and then traded at $90 as interest rates rose. The bank has $10 in unrealized losses, essentially what SVB went through. But if they held the treasury to maturity, the value would recover to $100. These fluctuations affect both loan and securities, can be managed through derivatives. A bank's unrealized losses are opaque because of accounting choices and valuations, but usually those losses don't matter unless you need to raise cash. So if they hold the treasury to maturity, this wouldn't have been that big of an issue, but they simply didn't have the funds to meet withdrawal from depositors. Banks have a wide range of options to raise cash, but all these options depend on the market value of a bank's asset. So they will only lend against an asset's market value plus a haircut. A significant amount of unrealized losses means that a bank has less potential cash to meet withdrawals. SVB had a ton of unrealized losses. And they also had a ton of uninsured deposits as well, stretching over 90%. What does this mean? It means that the vast majority of their deposits were above the $250,000 FDIC insured limit. Head and shoulders above any of these other banks here on this chart. First Republic, BMO, Huntington, KeyBank, Fifth Third, not third, M&T. Nothing really comes close. So it says here, deposit liabilities are difficult to value because they can in theory be withdrawn at any time, but are in practice sticky. The account balance of a typical depositor fluctuates, but they usually keep a certain sum in the bank. Rather than an overnight loan, a deposit is more like a long-dated zero coupon bond. The value of deposits are not marked to market, but in theory, they become less valuable with higher interest rates. Higher interest rates can reduce the value of a bank's assets, but they can also reduce the value of the liabilities. A bank that manages its liabilities well will not need to fire sell its assets to meet withdrawals. And then finally, higher rates decrease liquidity. Like we talked about before, the level of liquidity in the banking system is exceptionally high, but is set to steadily decline from higher rates and QT. Higher rates reduce the market value of bank assets, which reduces the amount of cash that a bank can raise. A secular upward swing in the interest rates can potentially impose huge losses on both the securities and the loan portfolio of banks. At the same time, QT is set to steadily withdraw over $1 trillion in liquidity out of the banking system over the next 2 years. Not a problem today, but it could be in the coming years. And this graph basically shows the unrealized losses piling up in the system. This goes all the way back to 2008, and this even overtakes the numbers in 2008. Started to see it here in 2022. In peaking at around $600 or $700 billion in unrealized losses across the system. We've got held maturity security here in blue and available for sale security here in yellow. So a much higher ratio of held to maturity securities with unrealized losses versus the yellow here, or the gold, available for sale securities. So there doesn't seem to be a big issue yet when it comes to the banking sector. This seems like we've got this situation fairly contained. But I will say this. The speed at which the Federal Reserve and the Treasury, the fact that they had to spend all-nighters on the weekend to quickly put out this fire tells you how serious the situation is, how serious the situation was had they not intervened. I'm not trying to make a case for bailouts or all this stuff, but this was a serious incident. And I think we should have our eyes open moving forward when it comes to the banking sector. What am I doing? I can't give you financial advice, but essentially I'm not doing anything. I still have my money in the bank. I'll act accordingly. It's up to you to decide what you're going to do. But I feel it's also important to show you the other side of the coin. So, the FDIC has a deposit insurance fund. And basically, this fund is the fund that's used to bail out banks in the event of a bank run. Bail out depositors in the event of a bank run. When the FDIC says that you're insured for up to $250,000, where does it get that money? It gets it from this deposit insurance fund. So how much money is actually in this fund? So at the end of 2022, it had over $128 billion in it. Okay. Seems like a big number, right? Well, that begs the question. How much insured funds are there in the system? Well, this is from Fred, the Federal Reserve, St. Louis Fed. And as of Q4 of 2022, there is $10 trillion of insured deposits in the banking system. And only $128 billion in the FDIC coffers in the event of a bank run. So how does this work exactly? Let's say your house gets hit by a hurricane. The insurance pays you for the damages, covers the damages, everything else. But then if the hurricane destroys all the other houses in a state or states, then the insurance goes bust. The insurance is basically banking on or betting on contained events. And it's the same thing with the FDIC. The FDIC can insure your deposits if it's within a contained event. But if everything collapses in on itself, there's not enough money. Who's going to be the lucky 1.28% of deposits that get bailed out from the FDIC? Probably not going to be you and me. And if we do get bailed out, well, there's an old clip floating around. I haven't pulled it up, but essentially, the Fed can just make up it. The Fed has an infinite amount of money. They can monetize as much debt into existence as they want. So if $10 trillion goes poof, they can bring it back on. They can print a bunch of money, add $10 trillion to our debt, the U.S. debt, and that'll be that. So essentially, you're pretty much looking at a highly inflationary event. Interestingly enough, ironically enough, of a bank run, because that'll force the Fed to start pushing all this liquidity into the market. Another interesting chart here. This is from Tavi Costa on Twitter. U.S. Treasury cash balance has declined $136 billion in 3 days. Now, recent developments caused the U.S. Treasury balance to be drawn by over $135 billion in the last 3 days. This is the largest 3-day decline in a year and a half. The government cash balance is running low, and the source of this liquidity is drying up. The Fed may need to step in soon. Note that the recent decline is as of last week, and the updated number is likely to be even lower today. So, we saw a $136 billion decline last week, before this SVB collapse and all this stuff. What do you think, where do you think we're at today? And also, interestingly enough, notice how the U.S. Treasury cash balance peaks here, around spring of 2022. So hold that thought. This is the Fed funds rate over the last couple of years. And when did the Fed start QT and hiking rates? Well, around spring of 2022 is when we saw the Fed funds rate start to launch. So what am I getting at here? The cash balance in the Treasury started declining at the same time the Fed began QT and hiking rates. Which begs the question. Has there been sort of a balancing act, so to speak, where the Fed tightens, but the Treasury eases? The Fed pulls liquidity out of the system while the Treasury tries to counterbalance it by pushing liquidity into the system. And we're almost out of liquidity, guys. We're sitting at about $1 trillion about this time last year. And now we're down to $200 billion. We use up 80% of that liquidity. So once we draw down this huge cash balance in the Treasury, what do you think inflation is going to do? What do you think the markets are going to do? Have the markets just simply been sedated while the Fed hiked rates as the Treasury just pumped them up in the background? I don't know. Let me know what you guys think. Just a theory of mine. But nonetheless, TGA here, according to this tweet here, TGA here was also down $19 billion today. So the Treasury is getting squeezed, drained, whatever terminology you want to use. Okay, so inflation numbers came in today. And we are sitting at 6%. And the good times are here again, according to Twitter, FinTwit, the financial news, because we were all the way at the 9% level a few months ago. Now we've drawn it all the way down to 6%. This would have been considered a tragedy about a year ago. But 6% today, that's, you may as well have deflation, at 6% in the eyes of a lot of macro analysts. But we saw 6% year over year CPI growth. With food, we saw 9.5% growth year over year. With energy, 5.2%, under indexing the overall CPI. Also under indexing the overall CPI is all items less food and energy. So I've got good news for you. If you don't eat and you don't drive a car, or if you don't use electricity, then you've only got to deal with 5.5% of inflation. You are under indexing inflation. But the biggest driver of inflation for the month of February is food at 9.5%. So let's go and dig in to see what food items drove the inflation. So let's look at, turn this off, bananas. Let's look at these one by one. Bananas kind of holding steady. Didn't really move much. What about bread? Bread is in a bull market right now, as you can see here. Doesn't really look like, if you're a white bread kind of person, then you might want to start eating gluten-free, because bread's still ripping it higher. Chicken is kind of plateaued. We've seen an increase in chicken prices since about early 2021, but it looks like we've kind of plateaued since about the last few months. Eggs have been huge on the news. Eggs have skyrocketed all the way up to $4.82 a dozen. But look at this sharp drop in eggs, down to $4.21. Is it time to sell eggs? I think eggs may have topped here. Let me know what you guys think. Do you think that these food prices have topped? Or do we just simply small correction? Ground beef, or beef in general. Beef has kind of been moving upward consistently since about 2003. We have been going down since August 2022, but nonetheless, if you zoom out, the pattern is up. Milk has also been going up for about 5 years now, but it's plateaued over the last year. It hasn't really seen any movement upward. Oranges, you've got this little whipsaw pattern here. This kind of tells us that oranges are seasonal. You have a dip in oranges in February every single year, right? We had one here. Where is it? March. We had one here in May. We had one here in March. We had one here in February, March. So every time in the spring, we have this dip in orange prices, which is where we're at now. And then orange prices peak in the late summer because they're seasonal. Tomatoes have, just kind of been moving sideways. No real interesting action there. Electricity prices have been going up over the last 3 years. You don't need me to tell you that. Gasoline prices have come down. And utility has kind of plateaued as well after going up quite a bit in June of 2020. So all this inflation, all this money printing, and for the first time in history, after all these big rate hikes, the money growth here in black and the CPI here in red, these are the two indicators juxtaposed on top of each other. But we've got money growth here in black telling us that for the first time in many, many years, M2 has gone down 0.85%. It's below zero. Now, what was the last time this happened? Was it here? No, not in 1993. Was it here? Looks like it might be. So the last time we had negative M2 growth was in the 1950s. And this chart kind of tells us that CPI lags money growth. Money growth goes up first, or money growth moves first, and then CPI. It kind of makes sense, right? The money has to circulate into the system for inflation, for the CPI to pick it up through inflation. And so we saw our decline in money growth back in December of 2020, peaking here. But that was the beginning of our inflation, of our CPI going to the moon, essentially. But over the last few months is when we started seeing inflation come down. So is the CPI print going to follow this M2 money growth down below zero? We've been in a disinflationary environment, meaning that we're increasing at a decreasing rate. Right? We went from 9% CPI year over year to 8 to 7 to 6. We're still increasing year over year, but we're increasing at a decreasing rate. Deflation is when you're decreasing, not increasing at a decreasing rate, but just simply decreasing below zero. Let me know in the comments below. Do you guys think that we are about to see an episode of some serious deflation that we haven't seen in a very long, long time? And then finally, this is a tweet from Michael Cow. He says, "Dear Fed pivoters, when you zoom out and look at the big picture, does this look like a picture of financial stress that derails what the Fed has been trying to do for the last 15 months? It's as if people have completely forgotten the 2007-08 period. This is nowhere close, and this is basically telling us that market had a pretty good day. Despite banking failures, bank runs, bank collapse, CPI at 6%, market doesn't care. There's no panic. There's no blood on the streets. So the Fed, if you look at it from the perspective of the Fed, when will the Fed actually pivot? The Fed is going to pivot when they break something. That's the conventional thinking. Nothing's broken. Everything's still the same. You know, we had a little 20% correction from the tippy top of 2021, but you know, there's really no panic on the streets. The banking collapse thing with SVB seems to have been contained. So everything looks good. I know some people are expecting the Fed to not, you know, to begin to pivot, but the common idea now is, the common consensus now is we're looking at about 25 basis points this month for rate hikes. Now, this is coming off 50 basis points that was originally anticipated, but given all the chaos over the last week or so, 25 is what the market's betting on. But you do have Goldman Sachs saying that they actually expect no rate hikes this month. So we'll see. Let me know in the comments below what you think. Do you think that we are going to see a rate hike today? If so, or not today, but this month. And if so, what will it be? 25, 50, 0? With zeros, then it's not a rate hike, but nonetheless. Let me know in the comments below what you think. Let me also know, do you think that this SVB collapse is the beginning, the start of something more, of a contagion? Is it a contagious event that will spread throughout the entire system and crash, and then we'll all be poor? And if so, then why aren't you digging a hole in your backyard right now? Let me know what you guys think. And as always, if you enjoyed this video, go ahead and give it a like and subscribe. Hit the bell notification icon. Do all the YouTube stuff I'm supposed to tell you to do. And with that said, I will see you in the next video. Bye, y'all.